Hi, everybody. This is Josh Jalinski, the Financial Quarterback here. And we are joined by exciting guest, Dr. Lacy Hunt, internationally known economist, Executive Vice President and Chief Economist of Hoisington Investment Management Company, firm that manages $6.12 billion for pensions, endowments, insurance companies, and others. Dr. Hunt is the author of 2 books and numerous articles in leading magazines, periodicals, and scholarly journals. Among them are Barron's, Wall Street Journal, New York Times. Basically, he's been featured all over the place. So we welcome you back, Dr. Hunt, and want to know, what do you make of the recent stock market volatility? That's my first question.
I'm a fixed income investor, Josh. We don't make investment recommendations outside of the fixed income markets. It's just part of our agreement that we have with the regulatory authorities. So I'm going to pass on the stock. I will tell you this. In my opinion, the stock market is a very poor economic indicator. The wealth effect is a theoretical idea, but it's just not that important. Not enough of our people have significant enough holdings in the stock market to really influence anything to any significant degree. It's a positive when it's rising. When it's negative, initially it doesn't matter. If the stock market goes down a lot over a sustained period of time, then it contributes a little bit to economic deterioration. But the stock market, for me, is not really a very important indicator at all.
Now that we're into 2022, what are your thoughts for global economic performance as we seem to be coming out of the pandemic?
Well, the pandemic appears to be going away. I'm not going to speculate on whether that's the case or not, but the problem is that the issues that we faced before the pandemic, which were extreme over-indebtedness, deteriorating growth relative to what the trend rate of experience had been, and demographics now are all worse than we were in 2019. And moreover, we've taken on a record amount of new debt, and the demographics has deteriorated further. And so the economy is in actually very frail condition. The one plus is that both Europe and Japan are doing worse than we are. Go back to 1995, for example, Japan was actually a wealthier country than the United States in real per capita terms. And today we're 13% higher than them. We're 38% higher than Europe. Both Japan and Europe are more indebted than we are. So our performance is the best among the major economies. And it's really not possible to say what China is doing because there are so many problems with the veracity of their data. But we know that China has enormous economic problems.
Now, moving on, how does the U.S. economy, so as we compare to Japan and China and Europe, do you still think we are you've said this before, sort of the cleanest dirty shirt in the laundry pile? Would that be fair to say?
That's the case. It may change in due course. But for example, we're very heavily over indebted. Our debt's very unproductive. But our total debt is generating about, every new dollar of public and private debt is generating about 35 cents of GDP. In Europe, it's
Josh,
25 cents. And in Japan, the official numbers are 15, but they're overstated. So we have our problems, but the difficulties in the 2 other major areas where we have reliable data are in much worse shape than we are.
So your fourth quarter of the 2021 Hoisington Management Quarterly Review and Outlook had an analysis of real treasury bond yields and that negative real yields are associated with recessions. Can you elaborate on that?
Yeah, you would think that if the real yield declines, that that's a stimulant to economic activity, and that's in the very simple economic models. Under the assumption of ceteris paribus, we change one variable, hold everything else constant. But we don't live in a world of ceteris paribus. We live in a world in which everything's changing at the same time. The Latin phrase is mutatis mutandis. And when you get negative real rates, such as we have, it's an indication that economies are deteriorating. And that surprises a lot of people. They think that if over-indebtedness is going to rear its ugly head, it would do so by a spike in real interest rates. And that's not what happens. The debt drags you down, generates, initially debt can be positive, but if you continue to overuse it, you eventually get diminishing returns. That's where we are today. And so the excessive indebtedness makes economies weaker and weaker. And all of the debt that we took on to try to alleviate the pandemic, you can say it was politically necessary. Maybe you can say politically popular. But the fact of the matter is, it's going to be a millstone around our neck for a very long period of time.
So as we move on, let's look at inflation. We're nearing record high inflation, and it seems to be heading higher. You've been a contrarian on the subject, saying that we are actually headed for deflation. Are you still thinking this way?
My view is that what we're going to do here, as the fundamentals reassert themselves, that we will see deflation in the durable goods, significant deflation in the big ticket items, service prices, which are influenced by a lot of rigidities in government regulation and so forth. Those prices will continue to rise, but there will be disinflation as we proceed forward.
When will that be? Meaning, we've had you on before, kind of the Fed has said these COVID kind of supply chain issues could last another year to 18 months. When do we see deflation? I mean, I know that's a hard guess.
Timing is something that we don't really try to do at Hoisington Management. We take a big picture strategic view. We want to be positioned. One of the real problems for the Federal Reserve is that last year, when inflation moved above their target band, they didn't do anything about it. And they have a dual mandate. They have both the labor markets and inflation. And so they let inflation develop a momentum, and they now have to reverse that. There's a couple of things about that. The inflation is having a devastatingly negative impact on the budgets of a lot of people. We have about 77 million people that receive weekly paychecks. And in the 12 months ending January of this year, inflation has outstripped wages by 2.5%. That's the 12-month decline since July of 2008, when we were in the recession associated with the great financial crisis. And in addition to the 77 million people that receive weekly paychecks, we have probably another 30 million people that are receiving biweekly checks, but they're in the same pay range as those with weekly. 86% of our people earn less than $150,000. And so, and then we have 20 or 30 million people that are retired, and their income is rising hardly at all, and they have to face this 7.5% inflation rate. And so it's having a devastating impact on family budgets. And modest and moderate income households are being hit very hard. And when you create this situation, you do a lot of damage. So last year we had 6.6 million new jobs. That's a good thing. But we severely damaged the budgets of more than 100 million people. Trade-off was terrible. And so now the Fed is belatedly moving to control the situation. But this is not a skill that they've shown to possess in the past. If you look at Federal Reserve periods of restraint since the Fed was founded in 1913, they've been successful in engineering a soft landing only about 10% of the time. So they are moving against it, moving at a snail's pace, but in the meantime, they're leaving a huge proportion of the American household in extreme distress. And in the meantime, there's still upward pressure in certain items, food, fuel, and rent. All of these are what we call price inelastic goods. We don't have good substitutes for them. And so the inflationary process is a cyclical negative. The Fed has to do what they are going to do, but they've allowed themselves to get behind the eight ball. Another element that's in the picture, and I think will help to eventually unwind the inflationary process, is what's going on with inventories. When the pandemic hit, the key phrase that referred to inventory policy was just in time. It was a very bad situation to be operating. Under such a situation, the supply side disruptions came in, and inventories couldn't be delivered. But what is taking place right now is that there is a massive shift to what I would call just-in-case inventory policies. In the second half of last year, in the face of this stiff inflation, the growth in the economy, excluding inventories, was only 1% annual rate. The rest was contributed by inventories. And inventories will add a little bit more, but I think that a lot of firms are soon going to find out that they have too much stuff. And there's more goods coming in from China and around the rest of the world. There have been bottlenecks in the ports, but the president of one of the big shipping lines said that the international freight rates are falling. The dry freight index, measured by Baltic, is down 75%. The number of ships waiting to unload off the coast of California is coming down. And I suspect that there was double and triple ordering by frustrated people. And so the process is going to unwind due to the three forces: the damaging impact on the well-being of our households, the bad situation that the inventories were in, and then also the restraint of the Federal Reserve. But the notion that the economy will have a weak first quarter and do better, in my view, is quite misplaced. The economy is going to have great difficulty, and there's one other element that I'm keeping my eye on here, or a couple of other monetary elements. Since mid-December, the Federal Reserve has reduced the total reserves of the depository institutions by more than 10%. And the other deposits, which is the key component of M2, is now growing at only about a 1% annual rate, to 13% last year. And the decline in velocity that we've been experiencing, since the late 1990s, in my view, is going to continue. And so the monetary process is going to intensify. And I think that there is some confirmation that my view is going to be correct. A very prescient indicator is the shape of the yield curve. In other words, the spread between the short intermediate rates and the long rates. And as the Fed moved to end tapering in mid-November, we've seen the short intermediate rates rise very rapidly, and the yield curve is flattening. That yield compression tends to reduce the profitability of the banks and the financial institutions. but it's also a sign that investors believe that the inflation rate and the real growth rate will come down as we move forward, and that's certainly my view.
Do you put any stock in, yield curve inversion leads to recessions? Do you see that as an indicator?
Yes, and I think there's a real since if you look at the spread between the two and the 2-year Treasury and the 10-year, there's been an inversion prior to all of those recessions, 100% of the time. The lead time is about 14 months. And I think that one of the reasons that the other deposit liabilities have decelerated so quickly is because the yield curve is flattening. It hasn't inverted, but I think it's very likely that it will invert. And see, one of the great difficulties here for the Federal Reserve is they need to relieve this pressure on our modest households. And so let's say that the economy begins to soften up and the Federal Reserve pivots. We have experience with that. If you go back to the 1960s, when the Vietnam War inflation started taking off, William McKinsey Martin, who's chairman of the Fed, he was chairman of the Federal Reserve when I joined the system at Dallas back in late 60s, started to move against the Vietnam War inflation. And he conducted several rounds of monetary restraint. President Lyndon Johnson didn't like that, put a great deal of pressure on Martin, and Martin didn't reverse himself, but he didn't continue to contain the Vietnam War inflation. And the economy had a soft landing in 1967. You'd call that something of a victory, but then the inflation rate took off. Martin then had to raise rates even more in 68, 69. We had a recession in 1969 and 70, followed by another recession in 1973 and 75. So the Federal Reserve has put itself in a very difficult situation. They were taking a celebratory spin around the ballroom because of the actions that they took in the spring of 2020 to try to alleviate the pandemic. And they moved to dramatically support fiscal policy actions. But when you effectuate these so-called theories of grand design, you never really can anticipate all of the untoward consequences that might develop. This was the contribution of the great sociologist Robert K. Merton, and he described these theories of grand design as like the fellow that's out hiking and he sees a cave on the side of a mountain, and he's interested, so he goes into the cave and the path is clear, and so he continues to move into the cave and gets deeper into the cave until he comes to the end, and he wants to then retrace his footsteps, but unbeknownst to the individual, there's been a cave slide and the path is closed. So when you effectuate these grand theories, the path in is a lot easier than the path out. And frankly, the Federal Reserve's record has not been good. So they have to get the inflation under control to take the pressure off of so many that are hurting. But they have to stay the course long enough so that the inflation does not persist. Very difficult tightrope for the Fed, and I think that their greatest challenge was not in the spring of 2020, but what they do now and going forward.
But do you really think 100 basis point increase is really going to do anything by July? to stave off inflation?
Well, the interest rate is not really, the short-term interest rate is not that critical. Monetary policy works through several channels. There are the quantitative effects, there's the cooperation with the banking system, and then there's the shape of the yield curve. And the short-term rate, I would say, is probably the least important mechanism. So, for example, if you look at the money supply, which the Fed really doesn't control, it's determined by the total reserves, which the Fed does control, and the money multiplier. Reserves are supply, money multiplier is demand. And the money multiplier is in severe doldrums, indicating a lack of demand, which means that the banks have plenty to make reserves, but the economy is so heavily over-indebted that those reserves sit idly by. And I suspect the money multiplier is going to move further lower. The rate of growth in bank deposits is slowing down. Velocity, the Fed does also not control. It's determined by the marginal revenue product of debt. And when economies, when you start taking on a factor of production like debt capital, initially GDP gains. You continue to take it on, GDP flattens out, and you take on more debt, then you get diminishing returns. And so what we're going to see is the backside of all of the money that was borrowed during the pandemic. A lot of people believe that there is a positive government debt multiplier. Well, that's not what the academic research shows. The government multiplier is negative after 3 years. And because of the extreme over-indebtedness, the multiplier is becoming even more negative. And as a consequence of that, the velocity of money is going to go lower. And then the other thing that is working in this super over-indebted economy is that we have horrible demographics. We don't look at those daily. We don't hardly focus on them. But I can tell you that demographics are destiny. Our population growth last year was 0.1%. Some of that was the COVID deaths. But we haven't had such a small increase since the 18th century. And this last year was the first year that the increase in U.S. population was less than 1 million since 1937. Our birth rate was at an all-time low before the pandemic hit. And now it's moved lower, so it's family formation. And you say, why is demographics important? Well, demographics works through investment. Think of the cost of marriage, of having children, raising them, educating them, to the household, the business firms that supply to them, the state and local governments. So when you get an aging economy, our average age is going up, then this undermines investment. But the United States, fortunately, still has better demographic. Our average age is a little bit more than 38 years, but China is at 40. And every 2 years that go by, the Chinese average age goes up a year. And the average age in Europe is also higher than in the U.S. and significantly so in Japan. And their population growth is even weaker. So
you should thank me for having 7 kids then.
Yes, you did your part. You did your part. But the fact of the matter is we not only have these adverse debt and demographic structurals, but we've now imposed on it the deterioration in certain cyclical factors. And I would draw your attention to the sentiment surveys of the University of Michigan. They're the one that started sentiment surveying under the late Dr. George Katana. They have the longest series. It goes back to the 1950s. They know what they're doing in Michigan. And they have a well-established record. And for the last 5 months, including February, Michigan is saying that consumers have the lowest confidence, or the confidence levels are at the same in the same range as we saw in the early stages of all the last 5 recessions.
Wow.
People are worried. And why shouldn't they be? Because their real income is eroding at a very rapid pace. And in the Michigan survey, in the last couple of months, consumers have not only been saying that their real income is declining, but they expect their future income to also decline. And this is one of the consequences when you let inflation run. You can't let inflation run hot because you damage too many people. Friedman said that the Federal Reserve really should have only one target, and that's inflation. And so last year was a perfect example of that. So we provided 6.6 million new jobs, but more than 100 million people took it on the chin, both the right and the left chin.
So as I move on to another question, how does current Fed policy stack up against the historical performance of the Fed? You mentioned they're about 10% successful at staving off hard landings. How would you answer that question?
Well, what the Nobel laureate Milton Friedman said, and also the great Stanford economist John Taylor, as well as the late Carl Brunner and Alan Meltzer and others, is that that discretionary monetary policy doesn't work very well, and that monetary policy really only works well when you focus on the inflation rate, because in inflations, prices rise faster than wages, as we've seen, very painfully so, and that's for people that are working. Think about the folks that are, and they have a heavy proportion of their budget that is in these essential goods where you don't have substitutes: food, fuel, rent, and so when the Federal Reserve does not tend to the inflationary mandate, then you put yourself in this situation, and so that's where the Fed is. And it's a very serious challenge for them and for the rest of us as well.
So do you think the inflation that we're seeing, I'm trying to sum up, when does it lead to deflation? Like, I know the when question is difficult, but do you think, would it be fair to characterize your position as inflation then deflation? You just don't know exactly when?
Well, deflation in the big ticket goods. And in the durable goods in general, the service sector, you have a lot of built-in rigidities, government regulation, and so forth. But I think that we will, for the 10 years leading up to the Great Pandemic, we had deflation in your big-ticket goods, and we're going to return to that. That's really one of the consequences. Let me just give you a statistic. If you look at U.S. economic performance from 1870 to the late 1990s, in real per capita terms, we grew 2.2% per annum. Since then, we've only grown 1.1% per annum. In other words, we've lost about half of our growth against trend. When the pandemic hit, your per capita GDP was about 17.5% below the trend line. At the end of last year, our real per capita income was around 58,000, almost 59,000. If we had stayed on that trend line, we would be over 71,000. And so debt has this stealth effect. And we've had an unfortunate circumstance where we've had a pandemic, we've had supply side disruptions. The policy response has complicated the matter. Those will eventually be resolved. Unfortunately, the two main structural elements, the extreme over-indebtedness and the poor demographics, will remain. And so I don't think that for the longer term, inflation will be a problem. But but the Federal Reserve has to take the pressure off the families who are really suffering under the weight of inflation.
And how do they do that?
And if they don't do that, well, all that they can do is they can shift the aggregate demand curve downward. But when they do that, there's going to be less spending, there's going to be less demand for labor, and hopefully they can do it in a gently manner. But you see, the critical differential is the one between price increases and wage increases, and the Fed has no direct lever to do that. And so that's why they have been unsuccessful historically in engineering a control of inflation. The former presidents of the Federal Reserve Bank of Dallas and Boston argued very strenuously that the Federal Reserve should have discontinued buying $40 billion a month of mortgages after the housing sector began to set new record levels of sales and prices were setting new records. But the Fed kept buying. And now, as a consequence, we have inflation in that sector. It's transmitted over to rent, and that creates a thorny problem. But if you think of the average individual, if you go into the filling station and your tank is empty, you're basically a price taker. Maybe you can only fill up a half a tank and then try to figure out how to use public transportation or your bicycle, but people don't have good substitutes. The same is true for food. Same is true for rent. And so what has happened is that we have a problem that is very intense in terms of its deleterious effects upon many, many people right now. But the Federal Reserve has to walk this line. But even if they get it under control, and I suspect that they will, at least temporarily, you're still going to be dealing with the fact that the fundamentals of the U.S. economy are extremely poor.
So we're going to go to the audience. You're one of our all-time favorite guests on the program. You're loved. Did you know you became something of a YouTube star? I didn't know that. I think I was.
I don't need to hear that either, Josh.
Don't tell your wife. Yeah, I think he got millions of views on various hits. And on the app Clubhouse, you've turned into a bit of a celebrity too. People sit around and listen to your talks. And I have some special friends who wanted to ask you some questions. So I'll first go to Joe Carlasari, who's an attorney in Chicago. Go ahead, Joe. Questions for Dr. Hunt.
Hi, Josh, and hi, Dr. Hunt. Thanks for joining us today.
How are you, Joe? Nice to talk to you.
Nice to talk to you. So there's a narrative out in financial media that the Federal Reserve is all powerful. Some people seem to describe them as the Wizard of Oz to some effect. But, my personal view is no matter how many bank reserves you provide to the system, no matter how much QE or low rates at the front end you mandate, money creation is slowing. And we can see that things you point out, like the loan to deposit ratio. And also you see the structural issues you just talked about, things like demographics, aging population, unproductive debt, all those things you were just giving us a summary of, weighing against the trend. So really the question I'd like you to speak to, and it's something that's always on my mind, is, to what extent is the Fed and other central banks out there, are they pushing on a string? Aren't they at the point where we have negative real yields where they're effectively impotent to stop this negative spiral that we're in? And the only real way to push against this demographics of destiny that you talk about is through fiscal authorities, because that's what I'm hearing. And I guess, aren't we focusing too much on the central banks at this point, given the structural issues that are in play? I'd like you to speak to that.
What a profound question. Very, very thoughtful. My congratulations to you, Joe. The way I would phrase it is that monetary policy has, over the normal range, has become asymmetric. When the Federal Reserve wishes to tighten monetary conditions, they can still have a negative impact. And we're going to see that this year. And the reason that they can tighten and have an effect is because the velocity of money is falling. It works for them. And also the money multiplier is falling. And so these two elements they don't control in the picture. But when the Federal Reserve goes to stimulate, it has to take even more heroic efforts. So last year, in 2020, in the midst of the pandemic, they coordinated with an unprecedented degree with fiscal policy. Total reserves of the banking system increased 90%, unheard of in 2020, and then another 34% last year. Since mid-December, they brought it down 10% because those rates were unsustainable. But what they didn't count on was that the size of the program was so huge, it interacted with the supply chain disruptions to boost the inflation rate. Now, the other difficulty here is that we have this growing debt, which you referred to, which I've referred to. Now, smarter people than me have addressed this question of what do we do about the debt? And the best study, and I recommend that you read it, is from McKinsey Global Institute. And you can go on their website, McKinsey Global Institute's the think tank of McKinsey, and you can buy this 2010 paper. And they looked at 24 advanced economies, no banana republics, that became extremely over-indebted in the time period from 1900 to 2008. And what McKinsey did is they looked at the buildup of debt. They then tracked the deleterious effects of the debt, and then they charted the path out. And in the case of all 24 of these advanced economies for the time, the only path out was what McKinsey called a sustained period of austerity. And they defined austerity as a rise in the national saving rate. The national saving rate has three components: household saving, private saving, which is household and corporate, foreign saving, and government dissaving. And so here is the situation. We're not going to cure an indebtedness problem by taking on more debt. And so, but we're a modern democracy, and our people are hurting. They're not doing well. The growth rate's been coming down. They're worse off now than when the pandemic hit. Our household income from all sources, including transfer payments, interest income, and everything else in real per capita terms, is unchanged from where it was when the pandemic hit. So our people are not in a position to accept austerity. They wouldn't vote for it. So the risk is that we continue to try to solve this indebtedness problem by taking on more debt. In other words, McKinsey has pointed the way forward, but there's no practical political way in which we can take their advice. And that's where we are. Great question, Joe. My compliments to you.
Thank you.
Do you have a follow-up, Joe? Since your first question was so good.
Well, I guess the follow-up going to the last point you raised, Dr. Hunt, where you said because it's politically unviable to impose austerity. I'm sure that this is not the first time that has occurred. There's nothing new under the sun. So in those other countries where it was not politically viable to impose austerity, did the McKinsey study addressed whether there was how it comes to an end game? How do we reach the end game?
Well, you're a very smart fellow. You're a very smart fellow. Let me talk to you about those 24 cases. The most frequent way in which the problem was solved was either good fortune something fortuitous happened, or it was imposed by the international community and a country was forced to change its ways. The one example that's in that 24 was the United States. We became heavily indebted in the 1920s, 1930s. It led us into the Great Depression. And although we managed to shave off some of the worst aspects of the Great Depression, when Germany moved into Poland in 1939, we still had 17 or 18% unemployed. Then World War II hit, and we were able to then start. We experienced a surge in our exports because the rest of the world was in the war. We were initially selling to everybody, and then when we joined the war, we were only selling to our allies, and they were war zones, so they bought from us. But there was another very unique aspect about World War II, and that is that we imposed austerity. We imposed rationing. So if you wanted, you would get a ration book that would allow you to buy a few gallons of gasoline, a few pounds of sugar, other critical things. You couldn't buy a car. You couldn't even buy 4 tires. You might be able to buy one. And so what happened as a result of this, World War II was a period of austerity. We did it because we were in a great crusade to save humankind. And so the government ran deficits of 14% of GDP, but private saving was 25% of GDP. And McKinsey said that this was really a fortuitous outcome. Another one that was not very fortuitous was Great Britain, or the British Empire, at the end of World War II. Keep in mind, Britain had borne the heaviest cost for World War I, and in proportionate terms, the European cost, the British costs for World War II were much greater than ours. We were greater in absolute terms. And then at the end of World War II, Britain had difficulty rolling over its debt. So they had to start making decisions to cut back on spending. When one of them was that they cut back on military spending, and when they did that, they could no longer hold their empire. Remember the famous statement that Winston Churchill made about the British: the sun never, sets on the British Empire. But they disposed of the empire. When World War II ended, we immediately ended rationing in this country, but they had to continue rationing all the way to 1956. So generally speaking, the two main ways out historically was that you had something fortuitous happen, or it was imposed by the international community. Well, who today is going to tell someone else to get their debt house in order? We're all over indebted. Now there is a third type of fortuitous event that I think is worth mentioning, and maybe something like this could happen. Our first major debt surge was in the 1820s and 30s. We started building the canals, the early steamship lines, and so forth. But we overdid it. There was overinvestment, overconsumption, speculation, so forth. The panic year was 1838. Martin Van Buren was president. He had no idea what hit him. And the United States went through a very difficult decade of deflation, a lot of political turmoil. There were other things going on that weren't helpful to the situation. And we were really in pretty desperate shape. And then gold was discovered in California, Sutter's Mill. Not just a minor discovery of gold, major discovery of gold, which financed the Western expansion. And as a consequence of that event, the 1950s was the fastest peacetime decade of growth, the 1850s in the United States. So there may be something that comes out of left field that could work. But generally speaking, the things that have allowed it to happen really were not done of their own will. And so that's where we are. Great follow-up question, Joe.
Thank you. I'll yield the floor, Josh, and I appreciate it, Dr. Hunt.
I think it was some exogenous event. I remember when you came on the Financial Quarterback radio show, you were so kind to do it in the midst of COVID. I don't know if you remember this. And you
I do.
And you said that this was the moment. You were actually sort of hopeful. Savings rate went up. People were bootstrapping. That was the austere moment that we had, but we threw it away.
We had a chance there, and then we've had other chances. I'll tell you, the Milton Friedman, who I quoted earlier, he became very concerned of the way in which we were going, and he was concerned that not only was discretionary monetary policy not working, but the discretionary fiscal policy was not working. And so what he wanted to do was to control the range over which fiscal policy could actually make decisions. And so he proposed a constitutional amendment that would require a supermajority of 60% for Congress to run a budget deficit, and with the signature of the president. In other words, you just couldn't willy-nilly run a budget deficit every year, or unless there was some real pressing problem that the supermajority would vote for it. And there was actually bipartisan support in the early 1980s. And Friedman's proposed amendment passed the House, passed the Senate, but it did not get the 2/3 vote to go to the states. But I think Friedman saw the handwriting on the wall, and his solution would have worked then. The odds of passing that today, I think, are very remote.
Are we just at the bread and circuses phase of the Roman Empire?
Yep.
Well, I don't want to use that terminology, but if you look at the great empires of mankind, that we're well aware of historically, Mesopotamia, which was centered between the Tigris and Euphrates Valley, Rome, the Bourbons of France, and the British Empire. And the great economist Neil Ferguson has studied those four examples very, very carefully. And he wrote a paper 10 years ago or so, I don't recall exactly, called Empires on the Verge of Chaos. And they became heavily over-indebted, and indebtedness caused the economy to sink into poorer performance. And it's interesting that one of the greatest thinkers of mankind was David Hume. My professor at Temple University, Ingrid Rima, said that the Enlightenment could not have happened without David Hume. David Hume was mentor to Adam Smith. It was Hume's discussion of time and space that inspired Einstein's theory of relativity, according to Einstein. Hume was an incredible intellect. He basically knew everything about the world from the beginning of recorded history up until he died. And he writes these two incredibly powerful papers, one called Of Money, in which he lays out Fisher's equation of exchange, which says money times velocity equals GDP. He doesn't write the equation down, but he clearly knows that he understands the process. And then he wrote a second paper called Of Public Credit. And he looked at all of the examples of these empires that had become incredibly over-indebted, including Mesopotamia and Rome and a number of other smaller cases that history has long forgotten. And his concluding remark in this paper written in 1752, this extremely brilliant man, probably one of the 10 or 20 greatest minds of mankind, concluded by saying that when a society has mortgaged all of its future revenues, the state lapses into tranquility, languor, and impotence. Languor, of course, we get the word languishing. And I think that the econometric research of others indicates that when debt starts going above 60 to 70 to 80, 90% in the federal sector of GDP, that you begin to get an increasingly negative impact. And of course, now in the United States, government debt's more than 130%. All of the major countries of the world are at these excessive levels. And what the scholars have noted is that there is this nonlinear effect. The negative impact of debt is lower at lower levels of debt to GDP and greater as you go up. So you should ask yourself what in economics is nonlinear. And those studies caused me to raise that question. And what is nonlinear is the law of diminishing returns. It takes the shape of a parabola. There's a phase when debt's helpful, a phase when it's neutral, and then a phase when it's negative. And we're long into diminishing returns.
So as if you were on the if you were at the Fed, if you were a governor at the Fed, what would be your prescription for staving off inflation today? So if I was the president, I would name you as my Fed chairman. What would you do?
Well, I tell you what, there are smarter people that have been asked and answered this question. And the great monetary expert was Milton Friedman. And I've already alluded to this previously, but Friedman said that there should be one target of the Fed, that is inflation. And if you see inflation rising, the Federal Reserve has to deal with it. You postpone it, bad things could happen. In the mid-1960s, when the Vietnam War started bubbling over, Martin started but didn't get the job done. By the way, Martin was the Fed chairman that said that it was the Fed's job to take away the inflationary punch bowl when the economy is getting out of control. But yet when he was tasked with the job of dealing with the Vietnam War inflation in the face of withering pressure from the White House, he folded. And now the Federal Reserve was designed to be independent. And I think that what we want is the Federal Reserve not to get mired into the decision-making process of the federal government. We need them to act as a counterbalance. And I think that the objective is just to key on inflation, and if you get the inflation under control, then you can reverse yourself. In the 1970s, many people consider what we're seeing today a replay of the 1970s. And we did have some supply-side shocks, such as we've had today. They were all in the oil sector. Here we've had a major supply-side shock across many, many different sectors. But the 1970s was different. There was a major devaluation of the dollar when Nixon closed the gold window. We left the gold exchange rate standard. And then in the latter half of the 1970s, the Burns and then the Miller Fed, when inflation took off, what they did was they increased money supply growth rather than countering it. So the inflationary pressures steadily build. Also, the demographics were very powerful then. The economy was lightly indebted. The velocity of money was stable. But what the experience of the 1970s, the Vietnam War period, is that the Federal Reserve has been very ill-served. And the country has been similarly ill-served when the Federal Reserve does not focus on keeping the inflation rate from escalating dramatically. And so, to my way of thinking, the Federal Reserve last year did not have a proper strategic view of what they were trying to do. I know they wanted the economy to come back from the pandemic, and we did get 6.6 million new jobs, but the damage was far greater. That's just exactly what Friedman said is the case. Focus on one target, the inflation rate, and try to protect as many people as possible.
Yeah, the case of the cure may be worse than the disease. So, folks, you can go to Hoisington.com, and all of Hoisington's and Dr. Lacy Hunt's research can be found there from 2017 on. One of the most, one of the newsletters that I focus on a regular basis. Anything else? You work for Hoisington.com. You're also, part of the Wasatch Hoisington Treasury Fund. Anything else you'd like to plug while you're up
No,
here?
I just want to thank you, Josh, for this great interview. You're a tremendous questioner. And I want to thank the lawyer from Chicago for his two great questions.
Hey, Josh, I don't know if Dr. Hunt has some more time.
Do you have time for one more question?
Hey, Dr.
I'll try.
Hunt, I'm a big fan.
I mean, the thing about it is, Josh,
and it's getting
I'm
late.
getting a lot of questions that I would describe it as very fast, hard curveballs coming in on the inside corner.
Okay.
But yes, I'll take one more.
We'll take one more. Go ahead, Mo.
Thank you, Josh. Dr. Hunt, again, big fan of your work. And forgive me if this was already asked, but with the U.S. debt obviously at its highest ever, isn't the goal, or at least the underlying agenda of the Fed, is not really to fight inflation all the way and maybe just fight it a little bit, because at the end of the day, we're never going to be able to pay back this debt, and we're hoping to, or at least the Fed is hoping to inflate it away?
That's the theory, and you also hear the other theory is you let the economy run hot, and that will be beneficial. Well, there's no example that's ever helpful, because one of the characteristics of inflation is that prices outstrip wages. And can the top 10% handle inflation and prosper from it? Yes, absolutely. Can they handle deflation? Yes. But the fact of the matter is that most of our people are not able to deal with severe disruptions to their budget. And so what we have to do is we have to take policies that help the most people. There's always going to be an inherent conflict, but we have to take the sensible approach and do the best that we can for the most, not for the least.
But are you confident that the current governors in the Federal Reserve are capable of navigating that ship to the right direction?
Well, the fact is that we've never had a Federal Reserve that has done that job very well. We've had one very great Federal Reserve chairman, and that I am aware of, and I've studied all of them historically. The great leader of the Federal Reserve who had a tremendous strategic view, tremendous man, friend of mine, and I'm not saying what I'm about to say about him because we were friends, but it was Paul Volcker. And Volcker had a tremendous capability of understanding the big picture. And one of the things that was rather unique about when the Federal Reserve had success, and I would say their two greatest episodes of success were the 1950s and the 1980s. And in the 1950s, you had William McChesney Martin, who was a Democrat, working with a Republican president, Dwight Eisenhower. And they had different attitudes on a lot of issues, but they were able to reconcile their different political stances to achieve what was best for the country. And so, yes, we had three recessions in the 1950s, but in terms of what we've had since then, they were relatively modest. Inflation was not a problem. It was very low. In the 1950s, the budget was basically balanced. Not quite, but almost balanced. In the 1980s, you had Paul Volcker with this tremendous capacity of his. He was appointed by President Carter. Paul was a Democrat, served in the Obama administration, but he was working with a Republican president, Ronald Reagan. But again, like in the 1950s, Volcker and Reagan were able to work together for the benefit of the country, just like Eisenhower and Martin. And I'm not sure that you have those types of personalities. I hope so. Well, time will only tell. But that's what's needed.
So
another great question.
Yeah, another great question. As we conclude the interview, you get me thinking. So you don't think, and I want you to rephrase it just so it sinks in. The Fed should do what? You don't really think 100 basis point increase in the Fed funds rate is going to do much. What exactly did you mean by what you said for the prescription? Which I'm missing the exact phrase.
I think that the 100 basis points is part of the process, but I think what we will see is an unprecedented deceleration in money and credit growth, and the yield curve will flatten and then invert, and it won't have to invert a lot, in my opinion, and the reason it won't is because we have these structural problems of excessive indebtedness and very, very poor demographics.
So they just do a little bit. We might have that deflation. And then, so you were more of the opinion when I last interviewed that the inflation was a little more due to that the exogenous event of COVID and the supply chain shocks. Is that still your outlook, or it's here, it's hot, it may have been due to exogenous effects, but the Fed needs to act now type of a thing?
Whatever the cause is, Friedman would have said the Fed has to tend to business. When you have a supply chain disruption, keep in mind the aggregate supply curve is upward sloping, and so when you have massive supply side disruptions, the aggregate supply curve shifts inward, and then it cuts the downward sloping aggregate demand curve at a higher price level. Now, there was some demand acceleration because what we had was the theory of grand design. We borrowed $5.5 trillion. It was basically purely financed by the Federal Reserve. And so there was a short-term impetus from the demand forces. But we would not have moved to these higher levels of inflation had it not been for both of them working together. I personally cannot break down the ultimate cause. And I personally didn't think that the supply chain disruptions would last this long. And I also thought that in spite of the massive increase in total reserves, the velocity would decline enough to basically neutralize. It It didn't work out in a timing sense, but I'm never very good at timing. But in my opinion, it hasn't changed the fundamental story. The economy was facing a difficult period when the pandemic hit in late 1919, and the prospects are more difficult today.
Well, I want to thank you for a great interview. Folks, if you miss it, you can catch it tomorrow on New York's WOR, 7:10 a.m. We're also going to be on the iHeartRadio app, YouTube, The Financial Quarterback. And thank you all for joining us. And thank you, Dr. Hunt, as always.
My pleasure. Nice to be with you, Josh.
Great to have you. Have a great night.
Same to you.